So very good evening to all our mentorship traders. Friday evening, 28th of August 2020. What a wonderful week we had for the markets. We'll talk about that. I welcome all our new joinees to our trading community. Warm welcome to every one of you. I have few surprises this evening for you. I will be taking you through a very different route when we talk about the sectors. You'll be surprised and you'll like the concept that I'm going to share with you today. And after that, we're done with our sectoral and stock analysis. I will show you a new system that I've been working on for over a month now, the three-river trading strategy. So no more doubts and questions or FAQ to today, which we will take up on Monday morning. So without wasting any further time, let's take a look at what happened to the index. Now, this is our Nifty weekly chart. We are on 2 consecutive positive weekly gains, and what a beautiful move we had. We have definitely taken care of that 11,500 mark considerably well. And if you remember, it was that red rising channel. There you go. I'm talking about the Nifty daily chart and talking about this red rising channel. This channel had provided beautiful resistance to the market before, and now it's inching towards it. And if it manages to continue this way, we're looking close to that 11,800 or little above that. We've had an exceptional move thanks to the banking and financial sectors. If you recall, last Monday morning, we were talking about the very fact that this part of the sector of the market should pick up for the index to sustain above 11,500, and it did exactly what was needed. The index found very good support this week from that pocket of the market which matters the most, the bank Nifty, the financial services. Now, before we go there, before we look into the banking, financial services and other sectors, let's quickly sum up the Nifty view. Uptrend, of course, yes. Now, if you recall, I've been careful and cautious and careful and cautious over and over again, and the market doesn't even care about that carefulness or cautiousness. It just wants to rally further up. There's no doubt that the index has picked up a beautiful momentum and it will continue further up. No signs of any price momentum divergence on the daily. There was some on the weekly, which has now got negated. So there is no technical reason per se to be bearish. There is a reason to be a little stretched, overheated, overbought, which can mean consolidations, which does not necessarily mean correction. And neither do I see that that's going to happen in a very significant manner. A short-term correction of 3-4 days is fairly all right. The kind of corrections that we have seen all this while. So if this trend continues, we're looking at 11,800 and maybe above. But if you look at the short-term indicators, it has got itself stretched significantly. So any form of short-term correction is always welcome from the index. Taking you to one time frame lower, which is a 75-minute time frame, does allow us a bit of divergences, for which the short-term support of this particular bar, is around 11,611. So let's use 11,600 as the short-term support for the index, below which you can expect the index to come and test this triple moving average band. You can see how beautifully every time it has come close to that band, it has managed to find some support. So 11,600 is your first point of concern on the downside, and on the upside, if this continues further, then 11,800 is the level to watch for. So bullishness stays. Now, as I was sharing with you at the beginning of tonight's session, that I'm going to take you through the analysis of the sectors, the stock constituents within this sector in a completely different manner today. So I have taken a subscription of Stock Charts. Stockcharts.com, as you would know, is the fairly reputed website in the field of technical analysis and chart trading. It's been there for ages. I think it was there in 2004-5 also when I started my career. It used to look very, very different, but this was one place which I used to go back over and over again to read and understand more about technical analysis and its various nuances. There's this concept called relative rotation graphs, RRG graphs. I don't know how many of you are aware of this. I stumbled upon RRG graphs back in 2010, talking about a decade back, where I used to be the institutional research, alternative research head at Brick Securities in Mumbai. And that's where I stumbled upon RRG. I read a lot about it. I understood the concept. I worked upon it, created many trading systems based on it. In fact, on YouTube, there is a webinar which I took around 5 years back. Not exactly on this concept, but because it is trademark and you cannot use it, it is registered. But over the period of time, many platforms like Bloomberg, Reuters, and Stock Charts have started providing RRG graphs. I'll create different videos on this on my YouTube channel and tell you the way I look into RRG. But to know more about RRG, you can come to this website called relativerotationgraphs.com. Just type RRG graphs and you'll know. If anyone has turned off his camera, it's not needed. Please switch off your webcam. It's not needed. Thank you. Now coming back to RRG graphs. So stockcharts.com is one platform, website, which offers RRG graphs. From now on, going forward, in most of our Friday sessions, when we evaluate the performance of the sectors and stocks, we will do that through the lens of RRG. And as we extend further, as we discuss more and more on this concept, you will get to understand this better. So let me show you the sectoral RRG first. So I've created all the sectors here. Now, this box is the RRG graph. I'll come to this little later. First, let's look into 1 week performance of the sectors. This I have sorted in terms of percentage change, and we can clearly see Nifty Private Bank, Bank Nifty, PSU banks, financial services, media, and real estate. These were the main gainers, out of which the show, the portion which took away the show this week was the banks. It's needed. At the bottom, we can see the FMCG is negative, energy was marginally negative, and very, very marginally negative was metals and commodities. So that's how, from a 1 week perspective. If you see here, there's something called tail length. Stay with me for these Friday sessions. At the end of 4-5 such sessions, you'll get to understand more about this. So what I've done, I've extended this 1 week to 4 weeks just to get an understanding of, let's say, a monthly performance. So I can see media, which does not matter too much. It is primarily Z and PVR, which matters to this sector. Then I have metals, small cap. So the broader markets continue to outperform. Real estate has picked up thanks to the pretty good move from DLF. And then we have the banks. We have a little bit of auto down here. All the sectors are positive. If you are looking at a 4 week perspective, all the sectors are positive. The least ones is auto, FMCG, and pharma. Remember, this is the pocket, the FMCG, pharma, and IT. This is the pocket which led the rally at the very beginning, right? So these are the sectors. This is the pocket which is going down. Now, slow and steady, I'm going to introduce you RRG graphs. And every successive week, I'm going to explain to you a little bit more so that you get an understanding. Before I share these concepts with you, it's very important for you to understand that this is just a way of looking into the performance of a stock or a sector compared to an underlying. So if you see benchmark over here, I'm going to change it to Nifty. I'm going to update it. Let's understand this step by step. First step is we are evaluating the performance of the sectors compared to Nifty. Vis-a-vis Nifty, which I mean to say relative strength. Which sector is showing relative strength and which sectors are not. This is the main concept. And the founder, the designer of RRG graph, if you listen to his videos or his work, he also suggests the same thing at the very beginning of most of his videos. This is just a way of looking into the behavior of the sectors. It does not give you a very strong buy or sell signal. No, we have to match it. We have to corroborate this with the price charts. So please don't fall for it. Don't believe or don't think this is some kind of a holy grail or this is some kind of a secret way of analyzing. No, but it is visually very appealing. It has some value in it. And what is that value? As we discuss week after week, we will understand this. So it has 4 quadrants: leading on the right top, weakening at the bottom right, to the left it's lagging, and on top left it's improving. The behavior of the sectors of the stock generally, not always, generally is in a clockwise manner. So a stock or a sector which is leading will eventually weaken, will then move into lagging, then it will try to improve, then lead, and so on and so forth, it will move. This is the natural flow of the sectors. Having said this, that's not always the case. I have been working on them for many times. A stock which is leading can go to weakening, can go back to leading, can go to weakening, and go back to leading, and then go to lagging. Can go to improve, can come back to lagging, improve, and then go to leading. So all these kind of drama these sectors tend to do is all based on their performance vis-a-vis the underlying. In this case, we have taken Nifty. Now, what is this leading and lagging weakening point? What are these quadrants? So let me take an example, and it will be easier for you to understand. First, you see these are the tail lengths. So we are comparing how many weeks. Over here, I can do it for days, but it makes sense to do weeks first. So 4 week, I generally look into 12 to 13 weeks. I'm looking at a quarter. So see that the tails go up. So I'm looking at a performance of these sectors vis-a-vis the Nifty for the last 3 months. All right. And let's take up IT. You see, IT is oscillating between weakening and leading, weakening and leading. This is the flow of IT. To make this thing easier for you to understand, this is CNX Auto, which is currently at leading quadrant, which means it is outperforming the Nifty. It is doing better than the Nifty, both in terms of the performance as well as the momentum. If I increase the tail length of auto, see in the past few weeks back, 4.5 months back, it was in the lagging territory. Before that, it was in the weakening territory. So this is almost 30 weeks. Okay, so we're looking at 7.5 months. This is how auto has done vis-a-vis the Nifty. We'll talk about all these in depth later on. What do I make out of this position of CNX Auto on the leading quadrant? What does this mean? This means it's a leading sector. It's done better. It is doing better than the benchmark Nifty. But if you see over the last 1.5 months, the length of the tail is dropping. On the vertical axis, it's falling. On the horizontal axis, it's fine, it's gaining. It's gaining strength, it's losing momentum, which means it is approaching the weakening quadrant. It may approach, it may take its time and later approach, but it has started to relatively weaken, or I would say weakening of the momentum of the relative strength. You need to understand this. The CNX auto relative strength momentum coming down not necessarily means CNX auto will come down. Eventually it will. So we need to be a little careful. Like this, if we look at all the sectors now, yeah, if you look at all the sectors now, we can see that there are 4 distinct colors. The green is the leading one, the blue is the improving, red is the lagging, and the yellowish one is the weakening. This is how it is shaped up. So, IT, auto, small cap, metal, and mid cap. These are the leading. Of these leading, when we look into these, IT is all right, and I continue to have a bullish stance buy on a dip on IT. It's not losing. It did lose a little bit of momentum. Then you see it has picked up again. If you closely look how it has been behaving, it has fallen down the momentum. Then now it is picked up again. So all the funny things that they do, but bottom line is it is outperformer. We should look to buy on a dip. Auto, as we just spoke, is an outperformer but losing momentum. So buy on a dip. Don't chase. Small cap, gaining relative strength, gaining momentum, will continue to outperform, very likely. Metals, same story. Mid cap, it's kind of picking up right now. But from a trading perspective, my experience has been such, I generally look at the ones which are in the lagging, improving, and leading. Primarily the ones which are improving, this part. PSU Bank, real estate, Bank Nifty, private bank, financial services, and of course media. The good thing is, even after such an exceptional explosive move this week from the banking and the Bank Nifty, they are still in the improving quadrant, which means if this improvement continues, they will move rightward, means they will start to outperform the market. Outperforming the market, remember, listen to this very carefully. Outperforming the Nifty does not necessarily mean it will go up. If the Nifty goes flat, it will not go as much flat. If the Nifty falls, it will fall less. If the Nifty rises, it will rise more. Please keep this in mind. An improving quadrant does not necessarily mean it's going to blow out or give big moves. It's just saying that it's improving its momentum, and eventually it will go towards the right quadrant, so it will lead the sector. Leading can be in a rising market, leading can be in a falling market. The first day today, I'm exposing this to you, so I'm talking a little bit more about it. Successive Fridays, I'm going to take a lesser time in all these concepts. So bottom line is, even after this explosive move that we had this week from Nifty, from Bank Nifty and financial services, we should not shy off, and we should continue to look to buy these stocks on a dip. Let's say now I'm going to change this NSE sectors to banking, and now it will change to all the banks. Now I have it for all the banks now. All the banks, all of them are improving. None of them are leading yet. 10 of them are improving, 2 of them are underperforming. HDFC or lagging. HDFC Bank and Kotak Bank. Kotak Bank, of course. Now this is where we come into the picture in terms of the chart. So you will look into the chart of Kotak Bank. See, now it has given a breakout. You take a look at HDFC Bank. It's kind of range bound over the last 2.5 months. It's not going anywhere. This is getting reflected over here. The rest of them are all improving. Bottom line, from the sectoral to the stock, RRG graphs tells us as a trader, we should continue our bullish bias on the Bank Nifty and the banking stocks. Number one, majority of them are in the improving quadrant, which means going forward, if the market goes up, they will continue to go up with the market and outperform. If the market comes down, it is likely that they will not come down so much. So as a swing trader, look to buy on a dip. As a breakout trader, you can buy the breakouts because it's in the improving quadrant. Now, quickly, let's not waste too much time. We can talk. We will be talking about these over and over again going forward in all our Friday sessions. I'm gonna use this for our analysis purpose. It's really useful. So the sector which led this week's rally continue to be bullish on that. All right. Let's come to the bottom end. We see FMCG and consumer durables. These are the two which are underperforming. If I increase the tail, you can clearly see the clockwise behavior. Such a beautiful clockwise behavior over the last 30 weeks from consumer durables, and similarly FMCG also. Beautiful classical RRG graph, which means 30 weeks back it was lagging, it started to improve, went to leading, lost momentum, and now back to lagging. So we exactly know how FMCG 30 weeks back had picked up momentum and the story. If you want to corroborate this, it's always good if I can put these two next to each other, the chart and the RRG. And if I open the, sorry, let's come here. Yes. So if I go to NSCF, sorry, not NSC, Nifty FMCG, that's why it was not coming up. And if you look at the weekly chart, this is the weekly chart. So you can clearly figure out the 30-week performance from the Nifty FMCG. Now it's going down. So FMCG is lagging, consumer durables is lagging. So we should not be too much excited about it. We can clearly see 32,000 close to all-time highs acting as a resistance for the Nifty FMCG. I would take a closer look and see that the tail of the FMCG has started to go up. This going up means momentum has started to come over the last 1 to 3 weeks now. Too early to conclude, but once it starts to go up, means on the vertical axis it's gaining momentum, then the price gain will start to come. So not to be bullish here, but keep a close watch on both FMCG and consumer durable. But it's the pharma, energy, and commodities which are weakening. Now, commodities are all whipsaws all over the place, so cannot conclude very clearly. But pharma we can, very classical RRG move, and it seems it's heading towards lagging, which means that if the market continues to go up, the relay that we generally expect, the banks will slow down, the pharma will pick up. I don't think it's going to happen. I don't think that's going to happen. I think rather than pharma, it's the IT, auto, and the metals which will pick up. Because Sun Pharma, the pharmaceutical, CNX Pharma, alongside its large caps like Sun Pharma, Lupin, etc., may probably continue, as per this graph, will maybe underperform going forward. Now, this is where the RRG graph may fail. Let me tell you how. Ideally, we expect this, right? This is what you expect, but this may not happen. This can go up to leading, come down, go up to leading, and then do this. And that's why it always does not give a very, very true prediction about the future of the sectoral behavior of the stock. But we'll keep a close watch. Let's take a look at the pharmaceutical Nifty pharma index. This is a weekly chart. Look how stretched it is, and we've been talking about this fact. 2 weeks, it's not gone anywhere. That is why you can see this behavior over here. So we can expect some amount of weakening further from Nifty Pharma and the other stocks. But it's a strong uptrend. It's got relative strength. This positioning has relative strength. It's just lost momentum. That's it. It has lost momentum. It's not lost strength. So pharma is also there, but this is the space, the blue one, financial services. The banking, I think these are the one which will continue to perform. Long traders should be biased on this. IT has picked up momentum, has the strength, so IT should pick up. Auto is losing momentum, so be a little careful. Small cap, as I said, is on a roll. Metal is also on a roll. Mid caps is also picked up momentum. So out of these 5 sectors which are in the leading quadrant, barring auto, I think the rest is fine. The financial service and banks are also fine. Pharma may weaken, energy may weaken, so that's Reliance. Let's take a look at energy. Where are we? There you are. This is primarily only one stock, this guy. So Reliance may not perform. Let's see. And then FMCG and consumer lagging. Maybe later on it will pick up. As time progresses, as I walk you through these weekly sessions, we talk about the sectors. We will see how these tail shape up. Generally, I look at a 12-week, 10 to 12-week behavior. Today, I did this for the sake of you to understand this better. I was showing you 30 weeks. I have created all the sectors here. So I have the 108 stocks also on my radar. So I generally do this to check which are the stocks which are relatively doing better than the Nifty. I'll try and post some more stuff on this going forward in my social media now that I've subscribed to this. It will be easier for me and also very, very useful for you. You may not subscribe to this. I'm going to share some more, dope on this concept and this approach. All right, spoken a lot about it, taken a lot of time, but not a problem. Tonight, I'm going to introduce to you a newer concept, a newer approach, the three rivers trading setup or three rivers strategy. This is something that I've been working on of late. I'm going to share a little bit of this approach on my YouTube channel tomorrow. But before that, we will stop the market and sector analysis. I hope you enjoyed it, you liked it. Let's move ahead and let me introduce